Ladies and gentlemen, welcome back to ladies and gentlemen, welcome to part 2 of a discussion where ladies and gentlemen, this is the third time I've introduced the show, and that is a limit. That is an unspoken limit. I'm not going to do any more retakes. We're doing a 3-part series on why the Federal Reserve and other big central banks are not central banks, but they are markets of last resort. Please go see part 1 where we discussed, what did we discuss? We discussed the article, When You Aren't Actually a Central Bank, part 1, the real inflation. Now we are moving on to part 2, which is a Real Clear Markets essay posted on the 28th of May. The Fed is the perpetual janitor, cleaning up after itself. And what we're going to be discussing is a bunch of examples that lead to what happened in March 2020, because the Fed was given a lot of credit for rescuing the system. What happened in March 2020? We're going to build up towards that step by step. And Jeff, if you ask the mainstream orthodoxy, what happened in March 2020, they're going to say, well, the first thing that happened was that foreigners started to sell treasuries. And that's where we're going to turn to as our first example. If Government Finance Minister A has commanded that its Reserve Manager X needs to liquidate US Treasuries in the nation's reserve account post-haste, the lucrative relationship any primary dealer has enjoyed serving the reserve manager suddenly becomes fraught with, shall we say, potential difficulties. They can't just hang up on them like they might hang up on me when I say I'm selling this.
It's sort of the corollary to too many treasuries, except this time the dealers are getting stuck with treasuries that foreigners are selling to them. And then you're right, they can't say, well, no, I'm not going to buy this from you because that wouldn't be in my interest. But the reserve manager is going to say, look, we have this big relationship that's a huge revenue provider for you. If I'm going to sell you this treasury at the price I want, you're going to buy the damn thing and like it. And of course, dealers, that's really what a dealer is supposed to do. That's its job to begin with. So, in a lot of ways, that's really not that abnormal or atypical, because as we've been describing for years, foreigners have been selling treasuries in varying amounts going back really to 2012, 2013, and 2014. So it's not something like this is sort of unusual. It's actually become a really common practice. And so what really was unusual about last year was the volume of sales and all of them happening at once.
Now, Jeff, wait a minute. If I'm going to sell my triple levered Tesla Bitcoin crypto FANG stocks, I just go and I sell it in the market. I could, click. Oh,
yeah,
wait a minute.
Market,
what do you mean,
right?
the market? So, US Treasuries. I'm a reserve manager for a Nordic country, and I'm not going to sell my most valuable US Treasuries, which may be the on-the-run ones. I'm going to sell this stuff that's illiquid. I don't know what it's trading at. Jeff, people are asking, well, why doesn't the reserve manager of a Nordic country simply sell it into the market? Because it's the market with quotes?
Yeah, that isn't the market, right? That's the distinction between on the run and off the run. Off the run stuff is stuff that isn't really liquid. And when we think of the treasury market as a single thing. Mm-hmm. It's a treasury market for every treasury that in existence.
The biggest
when, as we
market.
know, there's how many 20-some trillion in treasuries out there,
mm-hmm.
and only a fraction of them actually trade. Most of them are just they're just held by pension funds and asset managers, as you said, reserve managers all over the world. And they don't need to trade. There's parts of the market that are liquid, and we derive the prices from them, and we assume that those prices apply to the illiquid stuff that doesn't trade. And that's mostly the case. I mean, during normal times, if an asset manager wants to liquidate an illiquid treasury, they won't really have any problem, by and large, because the dealer will step in and say, you know what, I'll buy that treasury from you, and I'll give you a decent price for it. I'll give you a market price for it. But it isn't really a market price. They're not selling into a market because the market doesn't exist. They're just assuming it does. And so the dealer steps in, and they become the market for the treasury, but then that creates a bit of a problem for the dealer.
We talked about this in a previous episode. The next step is that the dealer sends cash to the reserve manager. But we talked about it. Is there anything that we need to add from this broad discussion regarding the fact that this kind of cash is not yet cash that they may not have
Yeah,
the
the
cash
cash
when
is
they send it.
fungible, but we won't bother with that. We've talked about that before.
Okay, so it's not quite cash right away. It might be cash eventually by the end of the day. So
It's some form of credit.
some sort of okay.
Yeah.
So, however, while the cash piece has been taken care of, that's hardly the end of the matter. Now the dealer is involuntarily, he's been composed, he or she has been compelled to put it on their balance sheet. This off the run, probably illiquid US Treasury that contains some risk. What kind of risks are associated with US Treasuries?
Well, usually, since it's off the run, it's going to be a note or a bond, so it's a longer term instrument usually, which means it's open to interest rate and inflation and growth risk and all those other types of things. Where if we get into a inflationary period, the value is going to fall. And so that does, even though it's a U.S. Treasury risk-free quote unquote asset, there does entail some form of risk that this is not a Treasury the dealer decided it wanted to own. It didn't go out in the market and buy it. This is something that it has come into possession of because of its dealer functions. That means it has to do something about mitigating these risks.
They need to hedge this collateral. But you know
At
what,
the
Jeff,
least.
before we go there, we're already way over time. When you were in class and your professor said this U.S. Treasury is risk-free, did that sit in your craw? Did it get stuck in your craw? Because it did for me. When I heard it, I said, this is wrong. Risk-free. Whoever assumes it's risk, there needs to be an assumption for a risk-free asset. But surely they should have spent more time coming up with another option, another way of framing it. You can't go around in the financial world saying this is a risk-free asset. Am I crazy?
No, and it makes sense in a very narrow sense. Again, thinking back to Niels Bohr and all the other, in a very limited sense, it makes sense because what we're saying by risk-free is it doesn't have credit risk. But that doesn't mean there aren't other forms of risk. And you're right. What we should say is it's a benchmark. It's not risk-free because it's obviously not free of all risk. It's simply a benchmark by which we peg to the lack of credit risk, as if the other types of risk, including liquidity risk, as we're going to focus in on, are unimportant, when in fact they are paramount.
It's free of nominal credit risk. You know what I'm trying to say?
Absolutely.
It's so many layers of risk. Get out of here. It's just always bothered me. Okay.
But that's inherent in economics, is oversimplification of everything. And nowhere has that been more apparent than the monetary side, where we're just, again, what we've just talked about, Ben Bernanke's arrogance was that this is all really simple stuff. We don't need to pay attention to the details because the details aren't important. It's all really easy.
So we can hedge this. We just got a U.S. Treasury. We didn't want it. We weren't expecting it. We had to take it because this Nordic country is a longtime business partner, and we're not going to stiff them this time. This time. We take it, but we don't want to be stuck with it because there's some sort of risk. So what do? We hedge. There's several different ways of hedging. What are some of them? What happens next?
Well, you could go into the Treasury futures market if you want. You could do any number of other transactions, but let's just assume that the easiest, most simple way to do this is to short a on-the-run Treasury. Because then you're short the similar instrument of what you got on your book, which means if the price of the off-the-run Treasury note that you've taken in from the Nordic country falls in value, you're short an on-the-run Treasury, which means it will go down. I mean, it balances out the transaction that you've got.
But now aren't we in trouble a little bit because now we have to find this? No, we're okay. Are we balanced? So now it's hedged.
No, we're not totally balanced yet because now we're short a Treasury.
Yes.
We owe a Treasury to the marketplace.
Yes.
And so there's one more
then?
step here.
Yes.
Because we want to run a neutral book, at least that's what the textbooks say. We want to make sure everything balances out and we've got all our bases covered. There's still one base that is not covered, and that's we're short a Treasury. And we can close out that short by engaging in a term reverse repo, which simply means that at some point, we've sold the Treasury short, we've got the cash. We can use that cash to lend into the marketplace on a collateralized basis, which means we've got cash going out, we've got cash coming in, cash going out, collateral going out, and collateral coming in. And so all of these things balance. We've got our risk covered because we're short a Treasury that we got sold. We got that was sold to us we didn't want. We've got it hedged. We've got the cash all worked out. We've got the collateral all worked out, and all these things work in a nice, neat little package.
That's why they're paid the big bucks. That's why we make movies about them like Margin Call and The Wolf of Wall Street. Whew.
And that's why, figuratively, they're the ones who are jumping out the windows when things go bad. Because it's always the stuff you can't predict, where you realize that, yeah, this is hedge and all works nice, and it's a nice, neat, tight little package. But when it doesn't work, boy, it doesn't work.
And when it might not work, when it's not only some Scandinavian country putting that security back to you, US Treasury, sending it back to you, selling it to you, but you also get a phone call from the reserve manager of Poise and Zaire and what other country doesn't exist, but a lot of them, Czechoslovakia, and they all call you. And all those steps we went through, not only are you have to do that for more assets, but guess what? Other countries are calling other dealers, and it's a run for going through this whole cycle that we just explained. And what happens, Jeff, if there's not enough on-the-run securities, or if people don't want to take the off the run? What happens then?
Well, remember, as we said in the beginning, in our last episode, we talked about daylight overdrafts and funding the purchase, the original purchase from the reserve manager in the repo market. So we've got to remember that step here, and I don't think we covered it just before. So we've bought the asset from the reserve manager. We funded that in the repo market. We've hedged it by shorting a treasury, and then hedged our short treasury position by a reverse repo. So we've got all our bases covered, we think, except for we've now used an off-the-run illiquid treasury as a collateral, or at least one piece of a collateral chain in repo financing. So if we start to get more phone calls from reserve managers overseas saying, I need to sell you my reserve treasuries, you're thinking, well, what the hell am I going to do? I'll buy it from you, but at the same time, am I going to be able to repo fund these transactions because they're illiquid? They're illiquid. And while most people don't care about the fact that there's no liquid market for it, the one place where they care more than anything is the repo market. And if the repo market starts to say, this stuff is illiquid and I don't like the way it looks, and I'm not going to accept your off-the-run illiquid treasury to finance your purchase in repo, I need more collateral, or I don't even want the thing at all, you're left to scramble to finance what is essentially these unwanted and involuntary purchases from reserve managers.
And one way to do that would be to just sell right into the market and create a fire sale.
Exactly, but then you're in the same position that the reserve manager is. There is no market, right? You could sell the illiquid off-the-run treasury and hope that somebody would buy it, realizing that it's not going to be, I'm going to take a loss here. It's going to be at a loss creating transaction.
And is that what happened in March of 2020? It
was one of the most prominent features of the panic. And it was not just March 2020. Let's go back to October 2008. The same thing happened. So this is a repeated phenomenon. It's not just one idiosyncratic thing. This thing happens repeatedly. And so last March, you had this curious case of a monetary global financial crisis where the prices of especially long-term treasury, remember the treasury 10-year yield rose, and it rose precipitously during the worst of the crisis. And the reason was because you had all these reserve managers trying to put all of these illiquid assets onto the books of dealers, and dealers saying either I can't do it, leaving the reserve managers to sell them in the market, or the dealers taking a lot of these treasuries on, which they did, and then trying to sell them themselves in the secondary market because they couldn't arrange repo financing. And it was just an utter, complete mess. And it got to the point where, especially the off-the-run treasury market became utterly and completely illiquid. Whatever limited liquidity had been in the off-the-run treasury market before then just completely vanished. It's from the outside perspective, what that looked like was, oh my God, the treasury market has broken down. This is an awful thing that the treasury market has broken down. And who steps in but the Federal Reserve to save the day by essentially QE6 buying up these illiquid treasuries, market of last resort. The Fed steps in and Jay Powell's the hero.
What's surprising is that they actually talk about this. They usually don't, do they? But here's, you brought this out in your paper, that on April 8th, 2020, they released the meeting minutes, which are very scrubbed and blasé, and there's usually nothing in them, but they released meeting minutes about their March 15th meeting, and here's what they said. It sounds like they're reading your work, Jeff. In the Treasury market, following several consecutive days of deteriorating conditions, market participants reported an acute decline in market liquidity. A number of primary dealers found it especially difficult to make markets in off-the-run Treasury securities. How often do they mention off-the-run Treasuries? Never, right? And reported that this segment of the market had ceased to function effectively. This disruption in intermediation was attributed in part to sales of off-the-run Treasury securities and flight to quality flows in the most liquid on-the-run Treasury securities. Jeff, hallelujah, they know about it. They know what's going on. They read your work. So what's the problem?
Except they're looking at it as from their perspective, as I said, looking at it backwards from the end. They look at it as this was a Treasury market breakdown. We saved the Treasury market.
Because they bought all QE6. They bought
right,
everything.
And that seems reasonable. And in fact, most of the mainstream, especially the academics, have said, oh yeah, that's market of last resort. Here it is. It worked really well. The Fed saved the day by bailing out the Treasury market, which is supposed to be the creme de la creme of all financial marketplaces. And if that place was breaking down and the Fed saved it, tremendous job. Way to go, Jay Powell. You're a hero. And now you know why the Fed is talking about this, because they think it sheds positive light on everything that they have done. Look, we bailed out the Treasury market. Here's what was wrong with it. Except, no, that's not what really happened.
That's what a market of last resort should do, okay? But it's not what a central bank should do. Not one that...
Yeah, because, again, you're left thinking... If you're actually thinking about this in any kind of detail, even anything more than the mainstream media article, what you're thinking is, wait a minute. Why was everybody selling Treasuries to begin with?
That's part 3.
Shouldn't we ask that question? Don't you think that kind of important here? The Treasury market broke down, but that's not the first step. That's kind of sort of the last... That's a symptom. That's not a... Why was everybody selling in the first place? Let's ask that question.
Let's do that in part 3.